I guess as a bunch of independents that if you're thinking about and are interested in what makes your agency valuable, you might be thinking about looking to realise that value at some point in time. So I thought it'd be a good idea to establish some context for what comes and open this session with a brief overview of the M&A landscape for the marketing services sector. But first, just a little plug for Kingston Smith for those who weren't at our cocktail party on the opening night and who don't know us. We are a leading top 20 UK professional services firm. We provide audit, taxation, corporate finance advisory and consulting advice. We have 60 partners, 500 employees in 6 UK offices, and we've also got a US office in LA. We're a founder member of an international affiliated network, a global professional services association called Morrison KSI, and that has 375 offices in 88 countries. And the main reason that we've been invited here and why we like to associate ourselves with this particular event is that one of our UK offices is a specialist media and marketing services and technology practice. It's based in London's West End. We produce an annual survey, something called the Financial Performance of Marketing Services Companies, which is used for industry benchmarking, and my colleague Esther is going to be drawing on that for her talk in a few minutes. We advise on numerous marketing services M&A transactions each year, the bulk of them cross-border, and we've been voted Best Mid-Market Media M&A Advisor in the Acquisition International M&A Awards for the last 2 years. So if people are thinking of realising value, in order to have a successful sale, clearly it depends on having both a valuable and sought-after business, but also on being able to sell into a benign environment where multiple potential purchasers are active and minded to compete with each other for good businesses. So the question is the market buoyant right now? And I have to say that from where we are sitting right now is an extremely benign environment. I spend most of my time advising shareholders who are buying or selling marketing services businesses, and right now I'm as busy as I ever have been, and I've been doing this for 17, 18 years. But it's not just our gut feel. The evidence from the wider market we have been collecting supports our perception that M&A activity is buoyant. So I wanted to talk a little bit about the market itself. I showed this last year for people who were here, but this is our Kingston Smith Media Deal Tracker. It's available on our website. The web address is in the top left corner there. And what we've been doing is compiling a database of all UK media and marketing sector transactions. And so it's got a UK focus, but it's basically wherever a UK business has been sold or a UK business has bought something overseas, then we will track it in our deal tracker. It's a great tool if you're interested in delving into corporate activity in the sector. You can filter deals by participants, sector, country, and so on. Where prices are revealed, and of course they aren't always, we record that. And what we try and do is link to official press releases about the deal as well, so you can find out more about the individual transactions themselves. And as we build up this database, clearly what we can do is analyse it and work out what's going on in the space. So in terms of what our deal tracker tells us about deals within the marketing services and media technology sectors, we have a very healthy, active market with about 200 deals involving UK companies every year. Of the 217 deals we covered in 2016, approximately 1/4 are deals that we would classify as media technology, and that's essentially technology-driven media services businesses. And 3/4 are perhaps more traditional agency businesses, albeit these themselves these days will have a strong tech component. 2016 itself saw a big increase in total activity over 2015, but what we did see was a distinct tailing off of transactions completed in the final quarter of the year. And indeed, the first quarter of 2017 is also down. Our view is that this was a pause rather than a full stop, as people took time to digest the impact of the Brexit vote and also the US elections. The quality of the UK industry, as well as the fact that UK acquisitions are now perceived as something of a bargain following sterling's depreciation against other major currencies, leads us to predict no let-up in M&A activity in 2017 as a whole. And we believe that when the numbers come in for the last 3 quarters, they'll balance out the slightly disappointing start for the year. Regarding who's buying, Dan and WPP were the most prolific buyers last year, with more than 20 new acquisitions for Dan and 10 for WPP. And then other repeat buyers that we saw include the Marketing Group PLC, which floated on NASDAQ First North Stockholm in May last year, Next 15 and IPG. And of course, last year we started to see the sector disruptors, the likes of IT services company Tech Mahindra buying digital agency, the Bio Agency, and most notably the thing that got everybody talking, Accenture's acquisition of creative agency Karmarama. If we look closer at what people are buying, when we look particularly at the marketing services deals, we find that digital agencies account for over half of all transactions. PR and advertising also feature extremely strongly, but digital effectively sweeps all before it. And obviously digital covers a multitude of offerings, so we've tried to analyse that further and found that in 2016 it was full service agencies that were most in demand. And actually this return of the full service agency is something that we expect to see continue into 2017 as clients demand a more joined up service. Other than full service, companies improving their digital architecture and online digital experience led to digital design capabilities being the second most popular digital sector. And the demand for these skills in particular is coming from three sources: marketing services agencies, and then the sector disruptors that I mentioned before, professional services firms and IT services companies. What I wanted to do was take a look at cross-border transactions in 2016. This infographic shows the origin of buyers, which is the left segments of the flags, and sellers, right segments, for cross-border transactions involving UK companies. And just over half of the deals that we covered in our tracker in 2016 were cross-border, so involved either a UK company buying something overseas or an overseas company buying a UK business. Of our cross-border deals, 45% involved an overseas buyer and 55% an overseas seller. So this underlines the strength of the UK-based buyers. But obviously those results are probably somewhat skewed by the fact that our survey covers the activity of prolific acquirers like Dan and WPP, and they certainly showed no let-up in expanding their global portfolios last year. But the other thing we did see last year was that US acquirers were also very active. And I think my previous comment about the depreciation of sterling, particularly versus the dollar, may be relevant here. And again, we are seeing no let-up in US interest in UK companies currently. And then finally, a few words on how the market is structuring deals and how they're being priced, because that's the thing that everybody always wants to ask me. I think the key thing to note is that different buyers may be interested in you for very different reasons. You may fill a particular service niche for one group. You may help them expand into new geographies. You might provide a route into clients on their target list or consolidate client relationships for them. But one measure they are all likely to be interested in, and therefore, when it comes down to it, a primary driver of value, is profit. And so profit will underpin the eventual valuation placed upon your business. And what most buyers do is frame their offer around a multiple of your profits plus pay you for any surplus that might be on your balance sheet. Now, the key question there is, well, what multiple will they use? And the honest answer is that we've seen a complete range applied. But as a ballpark, most of the deals that we've advised on recently here in the UK have tended to fall in the 5 to 9 times EBITDA range. That doesn't mean we haven't seen lower multiples. We've seen offers with multiples as low as 3 for small, also-ran businesses. And indeed, we've seen multiples get into double figures when the entity being sold has a particularly strategic niche or desirable service. Particularly digital tends to attract higher multiples. And as far as timing is concerned, most acquirers are clearly keen to see key management remain locked into their business. These are people businesses after all, so they don't want to see the major assets walking out the door on day one. And so therefore, offers tend to be structured with a down payment followed by a 2 to 4 year earn-out. That's pretty common. Or we see variations on that theme whereby acquirers buy a portion of the business on day one, but then leave the sellers as shareholders and partners in the business, maybe buying the remainder of their stakes over a longer period of time. That's basically the two different ways of doing effectively the same thing, making sure that the people who've developed the business and grown it to a point where you are now prepared to pay significant sums for it are locked in for a long enough period to allow for a handover. That's, a very sketchy setup of how a deal is basically structured. Every deal is different and every company is unique, and I'm more than happy to chat over lunch about some of the things that we've found more recently. But anyway, I hope that serves as a quick overview of the market. I'd now like to hand over to my colleague Esther, who'll be looking at what constitutes an attractive agency within that market.
Nicola. So, I mean, clearly, if you've got aspirations to sell your business, then you need to make sure it's attractive. And there are a whole host of qualities that feed into that. But I'm going to focus on financial performance here today, which is a pretty key one. And obviously, financial performance is all relative, depending whether you compare yourself to different people in your competitors and different markets. We know how important this is for our clients, and so for the last 26 years we've been collating information from filed accounts at Companies House to look at the key performance indicators of different agencies, and we segment them by different disciplines. So this is UK data I'm going to be talking about, but I think the key performance indicators that I'm going to talk about are equally as relevant whatever territory you are in. So I'm just going to share some of that data with you. Now, this is an overview of the last 26 years of the average growth in fee income. And obviously you can see the dips there in the various recessions, but the key thing coming out of that, I think, is the recovery after each recession. The growth that comes back is lower than it was before. Obviously, planning for growth is really important if you're gearing your agency up to sell, and I think if you don't plan for growth, then you're likely to go backwards. So you need to make sure that you've got a well thought out approach to new business and the sort of business that you pitch for, and be very selective about the type of work you go for, and go for the work where you think you're going to be more successful and you have more chance of winning, because we all know how much time and effort goes into every pitch, and pitch lists are getting ever longer. And then if we just plot the history of operating profit margins compared to the operating profit margins there in the blue line against that income growth, you can see there is a degree of correlation there. I think that's to be expected in periods of growth. The sort of the lag in taking people on to service that income tends to be there, so you get a bit of a quick win on the margin for a while. And then similarly, when the growth slows down, if it's unexpected, it takes a while to reduce the head counts. But again, you can see there, I think the key thing coming out of there is that after each recession, the recovery is less than it was before. So goodness knows what margins we'll be looking at if I was stood here in another 20 years, which hopefully I won't be. It's kind of only going one direction of traffic at the minute, which is a little bit worrying. But each recession we have, there's not loads of agencies going bust like there was perhaps the recessions 20 years ago. Agencies do tend to seem to be much more financially grown up and able to deal with the different economic climates that we find ourselves in, and they kind of are able to cut their cloth accordingly a bit quicker than they used to sort of 10 or 20 years ago. This is my favourite key performance indicator, one I bang on about a lot. And it's one of the most significant drivers as to whether an agency is profitable or not. It's the percentage of its revenue that it spends on staff costs. And as you can see, that ratio is going in the other direction, which is why a large contributor as to why profit margins are declining. I think it was interesting to hear the talk from Adam that actually perhaps, and part of that is because people are getting more expensive, and part of it I think is this whole kind of clients want more for less. So it was interesting to hear that perhaps, being constrained on resource or being constrained on budget actually can lead to more interesting, compelling, effective communications. I think that's a really great idea, and I hope that's true, and perhaps margin, if everyone takes note of that, maybe margins will start going back in the other direction. We recommend that agencies don't spend any more than 60% on their staff costs, and when we say 60%, we're including freelancers in that. Unfortunately, this data doesn't include freelancers because it's not publicly available information at Companies House. I'll come onto it a bit more in a minute. So that's just 60% on the payroll. That's without the freelancer costs. And on an average, not hitting our targets. This just kind of really neatly demonstrates the clear correlation between the amount of your revenue that you spend on staff costs and what margins you're likely to make. As you can see on the left-hand side, spending very little of your revenue on staff costs, margins sort of hardly any of them are negative, and they're mostly sort of up in the 10, 20 or above. As you move to the right and you spend more of your revenue on staff costs, the margins are kind of just tracking that black line. And so that's data from all of the 250 companies in the survey. So, it's so important to make sure that your staff are as productive as they possibly can be, that you use your staff efficiency, that you know what the capacity of the agency is, ideally run sort of just below this capacity, because I think running at it or more than at capacity will maybe give you quick wins in profitability in the short term, but ultimately will lead to poor service and lack of clients. And make sure that you give your staff chargeable targets, and that they know the difference between good over-servicing, sort of good servicing and over-servicing. I think it's really funny that the whole industry calls it over-servicing. We just call it write-offs. I think calling it over-servicing gives it this, that's all it is, that's what us accountants call it. Calling it over-servicing kind of gives it this positive connotation. If it's something really good, it's not really good, because it ultimately drives your profitability down. So stop calling it over-servicing, because your staff probably just think, oh, it's great, I've really over-serviced this client this month. No, it's not good. So use timesheets, analyse profitability, work out what your write-offs are and which clients you're making money on, which clients you're not making money on. Another ratio that we track is the fee income generated per head, and we say that you should be targeting at least £100,000 per head. Obviously, if you've got a more senior mix of staff, then that gross income per head, or that fee income revenue per head, whatever you call it, should be higher. But of course, it's the blend of these two ratios. It's the blend of the fee or the revenue generated per staff and the amount that you pay the staff. The blend of those two key performance indicators is what gives you your ultimate spend on staff costs as a percentage of revenue. So if there's one KPI that you're going to monitor in your management accounts every single month and have a target, that is it. That was looking at sort of the averages of everything in the survey. We split it out by key disciplines. I won't go through them all individually because time is short, but you can see there that they're kind of all bounced around a bit, but they sort of all, again, sort of heading in the vague similar direction of generally downwards. And certainly in last year's survey that we did, 4 out of those 6 individual disciplines showed a decrease in their average operating profit margins. You can see media buyers there as kind of always been ahead of the pack, but actually more latterly, I think, as some of the challenges in maybe sort of, programmatic starting to disrupt it a bit. Some of the bad press it's had in the US about bad practices perhaps has started to dent margins. And PR as well has always held up very well against the others. I think, it's sort of the more consultancy-led end. It's done very well, moved into social media and grabbed the content space, and it's still generating healthy margins. And if you look over the last 26 years and take literally an average of the last 26 years, those are the average profit margins of the various disciplines. I've combined advertising and digital because we've only started tracking digital as a separate discipline for the last 10 years. That does drag it down a bit. But digital agencies still being the ones that tend to command premiums in deals, because everyone still needs to get into that area. Well, quite frankly, actually, if you're not in it already, you're probably really dead in the water. But so another group that we look at is the top 50 mixed discipline groups. So they're all independent, but they're all big enough to be a mixture of, most of them are a mixture of disciplines. And you can see there that their average spend on staff costs as a percentage of revenue is 62.1%. And again, you can see that 2011, for example, when it was only 58.4%, that was the year in which they delivered the highest margin. Again, that strong correlation between profit margin and the spend on staff costs. But as I said, this isn't the whole picture, because this doesn't include freelancers. That's just literally people on the payroll. So we did a sort of internal survey amongst all of our clients, just looking at the detail within their statutory accounts, just to see how much they do spend on freelancers. And on average, our clients are spending about 5.6%. It does vary quite a bit between the disciplines, advertising, digital, design are a lot higher, media buyer and PR spend a lot less, but this is a mixed discipline group. So on average, 5.6%. If you add that to the 62.1%, you get 67.7%, which is frightening, really, as an average. So no wonder their average profit margin across those top 50 mixed discipline groups was only 7.5%. Obviously, an average is an average, and the margins achieved between them varied enormously. But, you know, it's pretty disappointing that 10, double the previous year, made a loss. So of the biggest 50 independent mixed discipline marketing services groups in the UK, 20% of them made a loss. That's pretty disappointing. And, you know, they're quite big, you know, between 10 and 90 million fee income. They're not tiny little agencies. These are substantial agencies that should have enough scale to be able to make profit. And at the top end as well, there were fewer last year making margins above 20%, all contributing to this depressed average. Again, sticking with the top 50 mixed discipline groups, looking there just at some of the per head ratios. You can see that revenue per head has increased a bit, but non-staff costs really has kind of outstripped the increase in the revenues per head, and actually the profitability per head decreased. There was quite a lot of talk in the strategic reports about group reorganisations and overseas expansion, a lot of one-off costs in there, which have perhaps depressed that a little bit. But I mean, just going back to profitability, it's interesting. If we look back at year 2000, when average fee income per head was 67,000. If you adjusted that for inflation, today it would be 106,000, which would be within our target of 100 to 120. But they only achieved an average 89. So actually, in real terms, fee income per head seems to have kind of gone backwards a bit if you use inflation. I know there are many other different measures you could use to increase it. But it's not all bad news. These are the top 10 performers within that group. And as an average, they produced an operating profit margin of 23.1%. And that was because they kept their staff costs in check and only spent 54.2% of their fee income on staff costs, and similarly kept their non-staff costs under control as well. And it was a nice spread this year as well between all of the disciplines. Quite often it's heavily dominated by the media buyers. So those are the UK stats. Some of you will have contributed to a little international survey that we did. Unfortunately, we didn't really get enough respondents for me to give you anything terribly meaningful, because what I wanted to be able to do is to analyse it by country, and I'm hoping we can expand on this every year and get more people completing it, because there isn't that much data out there for, you know, relative profit margins of independent agencies in different countries. But of course, whilst there was quite a few respondents from the UK, I kind of got that data already. In the US, by the time I looked at every other country, there was like one or two in each one, and I can't stand here and, you know, try and pretend that those are reflective of the whole industry, so I'm not going to do that. So I've just picked out a couple of the more sort of qualitative questions that I can give you some feedback from the survey on, because I do want you to think there's a reason to complete it next year as well. So we asked what will happen to revenue, fee income over the next year, and 66% of people who completed it predicted there would be an increase, and of those 10% actually thought there would be a 20% increase, which I thought was quite bullish. In terms of what would happen to margins, about 40% thought they would increase, 40% thought they would stay the same, and 20% thought they would decrease, although more respondents from the UK were in that thinking they would decrease, and more from the US were in the thinking that margins would increase, so the US being more bullish there. We also asked, we gave you an option of sort of 5 or 7 different things that might put pressure on your profit margins, and the number one answer across all territories was fee pressure from clients. The number 2 answer for the non-UK respondents was general pressure on salaries. The number 2 answer for the UK respondents actually was the need to bring in freelancers to deal with the peaks and troughs in work. The third most popular answer for non-UK was the rapidly evolving digital landscape, and the third most popular answer for the UK respondents was the reduction of international spend due to the change in political climates. I'm sure the rapidly evolving digital landscape is still a challenge for us in the UK, but it's sort of been a bit overtaken by what's going on in politics and the economy and Brexit, etc. at the moment, unfortunately. Embarrassing, I know. So I'll talk about that. So one of the other questions was, are you looking to expand into other territories? And a third of the respondents were. The most popular territory that people were looking to expand into was the US, and that was particularly from countries like China, Canada, the UK, and US agencies looking to expand elsewhere in the US. And the only agencies citing Asia as a potential expansion area, mentioning Singapore and China, were UK respondents. No other country mentioned that they were looking to expand into Asia, which I thought was interesting. Can't give you a reason for that, just maybe the sample. So the only sort of meaningful information I could really find on fee revenue growth and profit margin, because I wanted to give you something, was WPP. They're the only kind of multinational that actually segregate their results by territory in terms of these KPIs. There they are. North America, obviously, quite a mature market, so the revenue growth there is a bit slower. And then you've got APAC, Latin America, and obviously including some of the emerging markets with much higher growth. And then in terms of margins, this is how it translates. So North America, I think in all but 2014, so in 2015 and 16, they've got the highest profit margins. Followed by the rest of the world down the bottom, which obviously includes the emerging markets, which had the higher growth rates in revenue, so perhaps not such a surprise they're delivering the higher margins. I can hypothesize as to why North America is delivering higher margins, perhaps bigger budgets, perhaps on average, because the UK market's quite concentrated in London, which is very high salaries, which isn't helpful to margins. The North American market, perhaps a bit more spread around on average, perhaps staff costs a bit lower. But these are all questions that I'd like us collectively to help find the answer to. And if we can build on that survey and do it every year and get more people completing it, that would be absolutely fantastic. Thank you.
Ladies, thank you very much indeed. We have got just a very brief moment for a couple of questions. Does anybody have any questions? Yes. Okay, let's get the balls out.
Thanks for a great presentation. Dean Weller, Generation Media, independent media company. You mentioned the increments in staff percentage salaries as a poor indicator of success. Can you, obviously we're in a very service-based industry, our people are our assets, so we invest heavily in our good people. Can you give us a perspective on other service industries in terms of what they spend on their staff in that service sector, whether it be accountancy or lawyering or that area?
Yeah, I think the trend is similar in terms of the percentages is increasing. I don't think the percentages are wildly dissimilar. It's difficult to see because when you look at a lot of law firms, accountancy firms, big consultancies, they're all LLPs, and so everyone's a partner. So when you look at the staff costs, it doesn't include
it doesn't reflect the salaries of the
as well. So it's actually really difficult information to get. But I think if you looked at it, I think probably they would be less. The percentage would be less. I mean, if you looked at Kingston Smith, for example, it's not wildly less, but it's not quite 60%, and their profit margins do tend to be a bit higher. Maybe we're just a bit more.
But maybe this is the new norm.
I think so. Yeah.
Because the cost of digital executives, as everyone knows in the room, is very expensive. It's a very it's a big skill that is under pressure. Everyone wants to buy digital agencies, and everyone wants a digital king or a queen in their agency. So I think that will be under pressure consistently going forwards, hence the lower profit margins on digital agencies.
I think that's right. I think it's massively pushed up the number of freelancers you need to use because the whole suite of digital skills is so broad that most agencies are not big enough to employ somebody. And indeed, a lot of people now don't want to be employed. They want to be freelancers, that whole trend for work-life balance. And freelancers are more expensive. And so, I think that is definitely putting pressure on margins. And Whether that's reversible or not, I'm not so sure. I think this is just a new normal, right? I think tough is a new...
Well, I think that's what's demonstrated by the slide you showed. There's peaks and troughs, but the general trend is down. And the key driver of that appears to be
but obviously at some point that needs to plateau, right? Or none of us are going to bother.
Yeah.
Or none of you are going to bother.
Yeah.
Hi, it's Fergus Hay from Ligas Delaney. Nicola, in your data, you suggested that there was a demand for full-service agencies, and with that, by the acquirers, and with that, I assume, a price premium that goes with that. However, I was at a conference 3 weeks ago where we had 4 global CMOs from mega brands saying the last thing they want is full-service agencies.
It was actually full-service, digital agencies, full-service.
Okay, so not integrated offerings.
Yeah, not particularly. But having said that, I mean, we've acted now on a couple of sales of smaller but integrated agencies and have had no shortage of interest in those. It helps to have a sector specialisation, perhaps. But
I think that's what we're kind of been saying to our clients. Actually, it's about the sector specialisation, making sure you can really add value rather than necessarily the discipline specialisation. So if you're a broad range of disciplines, but got your kind of 3 key sectors or whatever, then that's still very attractive.
Yeah.
Okay, I'm very sorry, because of time, we're going to have to move it on now. So, ladies, thank you very much indeed. Nicola and Esther, everybody. Thank you.